hand the conference over to Mr. Saurabh Mittal, Managing Director and Chief Executive Officer, Greenlam Industries Limited. Thank you, and over to you, Mr. Mittal.
Thank you. Good afternoon, friends. Thank you for joining us in the middle of the day. I hope you have had a chance to look at the data and the presentations on the exchanges. I have with me on the call Ashok, our CFO, Samarth, and SGA, our Investor Relationship team. So on the results, my comments or my review is that seeing what we did in the quarter two, we feel that we've done a pretty good job in an extremely difficult environment in quarter two. We've delivered nearly 40-45% of volume growth, very close to 60% of value growth. On an H1 basis, volume growth has been in the space of in the range of 70%. If you would compare H1 volume growth versus FY20, the volume growth is in the range of 35-38%. So clearly, we think we've gained market share in this environment. In the last quarter, the raw material costs were at the peak we've ever seen, and it still continues to rise, although not at the same proportion as it rose in Q2. There was severe supply side disruption in terms of availability of certain raw materials, longer lead time in imports of containers, longer lead time while we were shipping containers to more than 100 ports worldwide. And as you all know, 80% of our RM is imported, and we move significant amount of boxes inwards and outwards. It was quite a volatile and a difficult environment, but I think as a team, despite the challenges we had on both inwards and outward, we were able to manage the situation in a fairly good way. We have passed on price increases in the market in quarter two, but clearly price increases have not been passed in the same speed our RM costs went up, and there has been a lag. We are implementing price increases in Q3, some of which has already been implemented in October. Some will be implemented in the month of November. Ashok will give out more details of that in the call. So clearly, as we see things now, RM costs hopefully will not, spike up in a manner it did in Q2. Although we still think it's going to go up. Price increases, which need to be further implemented, have already been announced in the market, which probably will be visible, partially in Q3 numbers, I guess, and partially in Q4 numbers. On the demand side in the market, by and large, looks quite decent. And the domestic market and the international markets, we see the demand side is good, and there's a disruption from several unorganized, smaller size, mid-sized companies, in their ability to supply to the market. Several of them are running at below than capacity, considering non-availability of materials, considering significant investments which they need to do in the business because they stopped getting credits from suppliers, and they have disruption to their own customers. So I think the market situation seems to be favoring companies like us currently in both exports and the domestic market. We continued our brand building exercises through the quarter two. We invested into our markets in terms of certain product launches, catalog launches. The campaign we launched on PVC, digital, etc. So I think those long-term initiatives of the company continued as usual in the quarter. So by and large, this is more like an overview of how we think Q2 went for us, and the actions probably what we've planned for Q3. So going ahead, clearly the focus is on driving more volume in the value mix items. So try and improve value mix sales, try and increase per sheet realizations further, which would be a combination of price increases and sales of higher value-added categories. So that's the direction we are following internally. On the balance sheet side, the debtors have been by and large under control. We've been able to reduce net working capital. Inventories still seem high in value terms, also because of RM costs going up. So I think the focus on balance sheet, disciplined balance sheet continues, and I think we've done fairly okay on that front. So I think this is all from my side at this moment. I will hand over the call to Ashok. Ashok will take you through the numbers, and then we can respond to your questions and queries if any. Ashok, over to you.
Thank you, sir. Good afternoon, friends. I'll take you through the financial performance for the quarter and then on the half yearly. For this quarter, consolidated net revenue grew by 35% on sequential basis and grew by 57% on year-on-year basis and stood at 454 crore as compared to 289 crore in last year's same quarter. Gross margin degrew by 540 basis points, stood at 43.5% in this quarter from 48.9% in quarter 2 last year, primarily due to rising raw material costs. On a sequential basis, gross margin degrew by 240 basis points. Gross margin in absolute terms grew by around 40% to 198 crore in this quarter as compared to 141 crore same quarter last year. EBITDA margin degrew by 390 basis points and stood at 10.1% in this quarter as compared to 14% in quarter 2 last year. On a sequential basis, EBITDA margin degrew by 130 basis points. EBITDA in absolute terms grew by 13% to 46 crore as compared to 40.5 crore Q2 last year. Net profit for the quarter stood at 20.7 crore as against 18.5 crore last year. This is after an exceptional item of 2.6 crore, which in terms of entry tax demand with Rajasthan Commercial Tax Department. Company has availed the amnesty scheme to clear up the overall demand of 7.4 crore by paying 2.6 crore. Moving on to H1 performance, consolidated net revenue for the half year grew by 76% on YOY basis to 790 crore from 450 crore last year. Gross margin degrew by 470 basis points to 44.5% in comparison to 49.2% last year, primarily due to rising raw material costs. Gross margin in absolute terms grew by 59% to 352 crore as compared to 221 crore last year. EBITDA margin remained flat at 10.6% in this half year as compared to 10.7% last year. EBITDA in absolute terms grew by 74% to 84 crore as compared to 48 crore last year. Net profit for the half year stood at 38 crore as against 11 crore in last year. Moving on to segmental performance, Laminate segment performed well, and Laminate segment revenue grew by 34% on sequential basis and around 60% on year-on-year basis to 415 crore from 258 crore last year same quarter. Volume growth in this quarter stood at 47% on year-on-year basis. Domestic laminate revenue grew by around 85% on a sequential basis and 73% on year-on-year basis. Volume growth for domestic business was 64% on year-on-year basis. International laminate revenue grew by 6% on sequential basis and 50% on year-on-year basis. Volume growth for international business stood at 31%. EBITDA margin for the quarter stood at 11.5%, a degrowth of 470 basis points on year-on-year basis and a degrowth of 190 basis points on quarter-on-quarter basis. Production volume were at 4.47 million sheets, having a utilization level of 114%. Sales volume for the quarter stood at 4.74 million sheets, and this is the highest in our history. Average realization for laminates in this quarter was at 833 rupees per sheet. Moving on to half yearly, laminate revenue grew by 79% to 724 crore as compared to 404 crore in last year. Volume growth in this half year was 70%. Domestic laminate revenue grew by 93% in value terms and 85% on volume terms. International laminate grew by 70% in value terms and volume was 60% up. EBITDA margin stood at 12.3%, a degrowth of 110 basis points in comparison to last year. Production volume was 8.74 million sheets, a utilization level of 112%. Sales volume in this half year was 8.56 million sheets, and average realization during this half year was 810%. Moving on to other segment, decorative veneer and allied segment. This comprises decorative wood, decorative veneer, engineered doors and engineered doors. In the decorative veneer, revenue grew by 107% on sequential basis and grew by 70% on year-on-year basis to 25 crore as compared to 14.8 crore last year same quarter. Revenue for the decorative veneer business grew by 77.5% to 37.3 crore in this half year from 21 crore in the same period last year. Sales volume growth for this quarter was 71% on YOY basis, and for the half year it was 78%. Capacity utilization in this quarter stood at 33%, and for the half year as a whole was 24%. Sales volume stood at 0.35 million square meter, and for the half year it was 0.51 million square meter. Average realization for this quarter stood at 702 per square meter, and for half yearly it was 717 per square meter. Moving on to engineered wood flooring. The revenue degrew by around 12% on year-on-year basis and stood at 8 crore as compared to 9.1 crore last year same quarter. For the half year, the revenue grew by around 24% to 15.4 crore as against 12.4 crore last year. Capacity utilization stood at 9% in this quarter and 10% for the half year. Moving on to engineered doors. Revenue for the engineered doors grew by around 8.8% on a year-on-year basis and stood at 6.4 crore in this quarter as against 7 crore last year. Revenue for the engineered door business grew by 9.9% and stood at 13.3 crore in this half year as against 12.1 crore last year. Capacity utilization in this quarter and for the half year stood at 20%. Net debt for the quarter stood at 165 crore as against 213 crore at the end of last quarter, resulting a reduction. Net working capital days for this quarter stood at 68 days, an improvement of 33 days from Q1 FY22. That's all from our side. I would now like to open the floor for the question and answer.
Thank you very much. Ladies and gentlemen, we will now begin the question answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Vikesh Chera from Lucky Investment. Please go ahead.
Yes, sir. Thank you for the opportunity. Sir, I have one question on the slide 10 where we put some assessment on the laminates business gross margin, and the following slide, which is 11. So, the assessment is that the price increase that we had, like whether it is absolute or by mix, was about 5%. And the gross margin reduction in the laminates business is about 520 basis points for H1. Just wanted to understand the extent of the RM inflation that we are seeing, which is melamine and paper, and I presume that paper inflation continues even in this quarter. So if you could help us understand, what is the index of inflation, how behind are we in terms of the price increase, and what extent of price increase would be needed to recoup these lost gross margin in the laminates business?
Okay, so firstly, let me respond to you. Price RM cost increase is happening in paper, which is both kraft and decorative paper. Imports, freights coming in, inward freight has significantly gone up too. In chemicals, the costs are going up or have gone up in methanol, phenol, and melamine. As we talk right now, paper costs, kraft paper costs still continue to rise in Q3 too. Melamine costs still continue to rise in Q3 too, right? So this is on the RM cost situation, right? On the price increase in Q3, we are looking at we've announced a domestic price increase of approximately 7%, right? And now this is across various categories, various grade thicknesses. And in exports, we will be taking an increase of approximately 3% plus any incremental sea freight which comes in. So this is what we're trying to do. Now, will this recoup the gross margins, lost gross margins? Now, what is the base of gross? If you would compare it with last year, last year gross margins were shy of 50%, right? So will this be able to bring us back to that level? Maybe not, right? So along with price increases, we're also working in a more focused manner towards improving the value mix of the production. And with volume growth, we think even if there will be a dip in percentage terms of gross margin, but the absolute value, will make up, some part of it. So this is what we're trying to do right now.
Okay. Is it possible to give an index at the start of the year if it was 100 for the pool of material that we use in laminates?
Right.
Raw material, what it would be at the end of quarter 2 and what it is today? It's an index of, yeah.
In this, there are several other things which impact the price. Like we use several other grades of material. In case the composition of that has changed, that will have a bearing on the prices. So it will be difficult in terms of giving the raw material wise indices in terms of that for each individual item.
Okay. And this price increase that we have taken, let's say, are planning to take in quarter 3, at least on a QOQ basis, does it arrest the incremental erosion in gross margin, or the rise in melamine and paper and other costs is also again higher than the price increase that you have taken, and we might see some further erosions in your gross margin?
So typically, with the data we have, we can predict costs up to 3 months, right? So the price increases, mathematics and announcements were done in the first week of October, right? But after that too, there have been further increases in costs, right? So as we expect now, gross margins should improve versus Q2, right? But will it take care of the entire cost increase? Maybe not, right? Because even after that increase, there have been further RM cost increase as we talk now.
Okay, sir. Thank you very much, sir.
Thank you.
Thank you. The next question is from the line of Ashish Podar from Systematics Institutional Equities. Please go ahead.
Yeah. So my question is on your realization. So if I look at your laminate average realization, it is up by around 7% QOQ. So it is because of the richer mix or the price hikes you have taken during quarter. If you can explain on that.
Yeah, it's a mix of both. As we mentioned in the individual segment, in the domestic we have taken around 5-6% up to quarter two, and in the export around 3.5% we have taken the price increase up to in the quarter one and quarter two both.
Oh, that's for the first half, right? That's for the first half or for the quarter?
Practically, most of this will be in the quarter two, because the first half in the domestic market most of the market was shut. So practically, it will, even though figure is for the H1, but practically all of this will be in the quarter two.
Okay. And in terms of your mix, do you see any mix, change in the consumer or your market? Because I believe last year for some time it was the thinner grade which was selling more. So do you see that that trend had changed and now it is returning to normalcy?
No, so thinner grade was introduced at a point when COVID was on and market. This is like H1 of last year types. So yes, we are doing some thinner grade now also, but clearly the focus is on driving the value items, and which is showing good traction. And we believe that in this quarter we'll see more improvement in the post-ship realization, which will be a combination of price hikes and value mix improvement.
Okay, thank you and all the best, sir.
Thank you.
Thank you. The next question is from the line of Abhishek Ghosh from TSP Mutual Fund. Please go ahead.
Yeah, hi sir. Thank you so much for the opportunity. So just one observation. Is it that you are taking lesser price hike in the export segment and higher in the domestic segment? Is that the pattern that you are seeing?
No, so what's happening in exports, from January 21, we had passed on all incremental freight to the customer, right? So from a customer's perspective, actually effective increase to the customer in exports, it is equal or higher than domestic. So in certain, in many markets across North America, South America, Europe, UK, the freight increase, the differential freight which we passed on is anything between 10 to 15% to the customer. So effectively, if you see the export price increase, the increase we are getting is one part, but the increase the customer is paying is another story which we need to also review, right? So we've taken one increase in exports of about 3.5%. We're doing another increase of about 3.5%. And if you were to load all the incremental freight on the cost increase, effective cost increase to the customer, it'd probably be equal or higher than the domestic market. So we're actually facing that challenge also in exports with so many destinations and sea freight just getting completely out of control. It's a big challenge for us to be able to pass on the entire RM cost as well as the entire incremental freight.
Okay. And just a continuation to that, in tiles we are seeing that Morbi is facing issue in terms of exports, container availability. Also, there is some amount of cost disadvantage because some of the exports from the Western countries is probably becoming more lucrative. Is that something also that you're seeing in your part of the business because of the higher cost inflation, and plus the freight is making business incompetitive or disadvantageous?
So clearly freights have gone up and it is putting pressure on the business. But as you probably are aware, most of our markets, businesses, customers are long-standing customers. These are largely branded business, and these are businesses we want to support for a longer time to come. So clearly we continue to serve our customers and our markets, considering the newer capacity which will hopefully come up in next financial year. So really, yes, there is pressure. So I think that goes without saying. But yes, we continue to be, this will keep going on, but we can't exit markets inflated for so long, right? So we are looking at, we have been getting increases with the incremental freight being owned by the customer.
Okay. And sir, the new capacity comes in any broad timelines would you like to share in terms of when does it kind of?
No, so the timelines is unfortunately government doesn't have timelines. So we are in the last leg of some approvals, coming in terms of environment clearances which have been done. So I think we are in the last leg of it, and we had said that in Q3 of FY23, we should be up and running with the additional capacity. So we're still focusing on that. It might get deferred by a month or two, but at the moment we're still keeping that target on, right? So we're just in the last stage of closing all the approvals, and layouts have been finalized, etc. So I think once we get in the pool, we should be up and focused on building the plant.
Okay. And just one last question from my side and come back in the queue is, how is the unorganized kind of reeling under this pressure of overall increase in working capital, increase in this thing? Are you seeing constant market share gains by the branded? Well, you did mention about it, but if you can just probably elaborate a little bit on that.
So again, I can't back up all of this with the data of the unorganized companies, but what we hear from the market and what we know from our sales teams and our dealers and distributors, etc. Several unorganized factories are running at far lower capacity utilization. They're running short of raw materials, and there's working capital pressure on them to fund their suppliers. Earlier they used to get credit from vendors, and now they don't get any credit. They have to pay advance payments or immediate payments. So clearly, I think there is significant stress on the unorganized companies in the market.
Okay. Thank you so much, sir. I'll come back in the queue for more questions. Thank you.
Thank you.
Thank you. The next question is from the line of Sneha Talreja from Edelweiss Securities. Please go ahead.
Hi, good afternoon, sir, and thanks a lot for the opportunity. Sir, I hope I'm audible.
Yes, you are. Yes, go ahead.
Thanks, sir. So just wanted to check, a continuation to Abhishek's point, we can see that, in the domestic part, you've actually crossed the revenue run rate in the domestic market for Q4 also. And you're clearly, market share gains there are visible. In exports, we definitely see that, the quarter 4 and quarter 1 were in fact better. So what I basically wanted to understand, since it's a touch and feel product, and at least Morbi has been telling us that whenever things open up and trade opens up, there will be a huge amount of exports happening, which will be incremental. I just wanted to take a broader opinion from you also. Would that be the case for us? Are there more country additions we would be then able to do once things actually trade opens up, and can we see the share of exports going up further? That's first question.
Yeah, I couldn't actually follow your question very clearly. I think there's a little bit of echo. Can you repeat yourself, please?
I'm so sorry. I may be traveling because of that. I just wanted to basically understand your vision on the exports front, since there is container availability issues, freight rate issues, travel bans at this particular point of time. So what do you feel that where this division could head once these issues are sorted?
So clearly, we are focused on the export business from a long-term perspective, right? And there will be some challenges in that journey. And we're committed to our markets, and considering, like I was telling Abhishek, considering the new investment we have planned in Andhra Pradesh with the new capacities we want to build and can add, in a quick manner there on a brownfield basis eventually. So export market is clearly where we think, we will keep our presence active and, alive. And I think that market will also keep growing, once we have more capacity. So currently, I think the challenge is less of market opportunity. It's more, about our capacity. So we really want to get our capacity up and running. And I think these threats, the freight matters, availabilities at some point, will get normalized because this is not sustainable as we understand. So
actually,
yes,
in continuation to this particular point, sir, you said that our capacity is pretty much exhausted, which is visible in the numbers. And Morbi is actually, or maybe other unorganized players are also running at, far lower utilization at this particular point and clearly under stress. Is there any point we could actually, get those assets on maybe we can look out for outsourcing opportunity at this particular point of time since scenario is in a lot favor. There's a big amount of shift happening from unorganized to organized. We've seen outsourcing opportunities in other segments like tiles and all also. So just wanted to have that view from you.
So our sense in laminates business is that the outsourcing model is not very successful and very viable because the cost of production at our factory and our plants are lower than the cost of production of the unorganized players if they use our raw material specification and bill of materials. Because they cheat with the quality of raw materials and compliances, they are actually cheaper. Otherwise, it's not as if they are more cost efficient than us. And so our focus currently is on really getting our approvals sorted out and start building a new plant. Because once we start, we've seen that in the past also when we built the Himachal plant, from the construction date to production in 9 months, we were up and running. So our focus is on getting our capacity ready and getting to the market rather than diluting ourselves and focusing on an outsourcing model. Because to put the outsourcing model in place in terms of cost, raw materials, manpower, etc., will also consume time. So we're focused on creating our own capacity right now, Sneha.
Sure, got that. So, and prior to that, is there any ready facility or something that we could get as an asset for sale? Is that any possibility, or we'll have to kind of focus is only on the new capacity expansion?
No, focus is on the new capacity. So obviously there are a lot of companies, factories who are not able to produce, but their plates to produce laminate, the raw materials. I think all of that also to organize today the lead time for a lot of plates, decorative paper is running between 6 to 8 months. So even if one were to put that whole program to place, it would consume a lot of time with our quality standards.
Sure, got this. Thanks a lot, sir. And all the best.
Thank you. The next question is from the line of Achal Lohani from JM Financial. Please go ahead.
Yeah, good afternoon. Thank you for the opportunity. My first question was in exports. Are these exports on FOB or a CIF?
So some of our exports are FOB, some are CIF. CIF, the freight, average freight, I think December 20, that we are absorbing. Increment freight from January 21 has been passed on to the customers.
And what would that mix be, the CIF customer mix? Would that be like 50, 60, 80%, or would that be just 20-odd%?
Yeah, I think most of it is on a CIF basis. So I can say that it will be around 60-70%.
That's good. Because in the subsidiary companies, in US and UK, Europe, we are actually clearing the containers and then billing to the customers. So yeah, from India, that would be the consolidated CIF. Yeah.
Correct. Okay. And secondly, of the total exports, are all of the exports are under own brand, or is there any white label exports also which happens?
We actually don't do any white label either.
Don't do any.
We just some OEM sales large producers in Europe, but by and large it's all our own brand. But within the brand you have commodity partners, etc. But by and large it's our own brand.
Understood. And in terms of the RM, I mean, you did talk a little bit on that. But is it possible to get some clarity in terms of the extent of cost inflation in the kraft paper and deco paper? So is it possible to get some sense on a YY basis where the prices are? Like what is the cost inflation in those 3-4 key raw material items, including those chemicals?
Yeah, Achal, as I explained earlier also, that in this kraft paper also we use various grades of kraft paper that will have a various price point, and when the cost is increasing on a regular basis. We also do value engineering in terms of that, wherein the mix of what we were using, let's say 1 year, 2 year back, might change. So the actual cost increase to our books may not reflect the a price increase which has happened on the ground, but on a ballpark figure, if I give the various grades of glass wafer, it will range between 5 to 12-13% kind of a thing. And for decor paper, again, the various grades of decor paper is being used. So the SKU are quite high, but you can say that the around 10-12% price increase in the decor paper on an average. In the chemicals, on a YOY basis, the price rise is high. It ranges from 70% to 100% also.
Right. And broadly, what would be the cost mix in terms of the craft, deco, and chemicals?
So roughly the paper constitutes around 65% and chemicals constitutes around 35%. So a couple of percent here and there might happen depending upon the price rise in the individual segment.
Understood. And, in terms of the floor and door business, now, we understand that, the demand situation is fairly good on the real estate front for the building material categories. But I see, we are still having pretty much subdued volumes actually in both flooring and door business. So you want to elaborate a bit on as to how you look at this now, since we are seeing a pickup on the demand aggregate?
So, on the floor and door, you're absolutely right. I've seen improved inquiries, improved questions being sent to, customers. Several meaningful orders have also been finalized for doors, and we believe that this should improve, as we move ahead, as more orders are being finalized. So clearly, I think we should look better going ahead.
And Achal, one more thing in this, I would like to add that again, this stores and doors have mix of domestic and exports both. So
right.
Clearly, what Sir said that we are seeing better inquiries, and even the sales are also going up. In export side, again the freight and all this plays a major role in terms of that. So where the probably a demand is a bit subdued. But in the domestic segment, we are seeing, as you rightly said, we are getting good inquiries, and as hopefully that will convert into sales. That has started happening in this quarter also, and going forward also, it will bring more revenue.
Got it. And is it, in terms of the number, can we then look at a profitable bottom line or EBITDA for the floor and door business by fourth quarter? Would that be a fair assumption?
Well, that clearly is what we also want to do, and in floor door also, but unfortunately, all the raw materials imported, and freight costs, price increases are happening on the wood veneer side also in terms of lumber, timber cost. The fire-rated particle boards we buy, the wood we buy, is backed up with the freight increase. So we are increasing prices there also. Rather, we have all these increased prices in the wood veneer section, which is decorative supply, flooring, and doors too. So I think the demand side in the domestic market should look good. RM costs have risen, freight has risen. Exports of flooring will become challenging going ahead because we never had our own brand. It was all outsourced, like a white label thing. And freight as a percent has significantly gone up to the market of shipping to. So there's a little bit of a shift in the dynamics there too. But clearly, I think the focus is now completely on the domestic market, and we have passed on increases to the market.
Understood. And just one last clarification, if I may. You said, 90% of our raw material is imported. Is it the case for the industry as well, or it's only for us, which is at a higher end?
So I said 80% of the RM is imported or pegged to imports, if I may say so. So decorative paper is, I think for us and our nearest competition, I think it'll be a very, very similar situation in the laminate business. In the wood category, we don't have a comparable player. So in the decorative, in the wood and the light category, decorative veneers, flooring, door, you could assume 100% RM is actually imported. Base ply, veneer, lamella, particle board, timber, everything is important, everything.
Right. So when you said, imported or pegged to import price, I was more keen to understand in terms of physical imports, because that's where the freight will have a disproportionate impact. Would that be a right way of looking at it?
No, sir. It will have in the similar. Let's say in case of formaldehyde, it is getting converted from methanol to formaldehyde. So whether I buy directly or they buy and convert it to me, that cost will be passed on into the market. Where my supplier also depends upon the input. So that's what we were telling, the peg to import. And even let's say in case of phenol, which we are buying locally, let's say some of the percentage are buying locally from Deepak Phenolic, but those prices are pegged to import. So if the prices in the international market goes up or down, that similar impact will have in this. So that's what we mean to say, that either direct import or pegged to import, the price inflation or increase or decrease happens in the similar manner in terms of imports.
Got it. Sorry, one more question, sir. In terms of the volumes, we said we have operated at 114% capacity utilization for the second quarter. Is that the best we can achieve till the time we have the capacity in place?
Well, you can assume few percentage points can be improved, but in terms of volume, we are near peak in number of sheets. Yeah.
Right. But the product mix can improve, as you said.
Absolutely.
In terms of the value. Got it. All right. Thank you so much. Sure. Thank you. All the best. Thank you.
Thank you. The next question is from the line of Udit from Yes Securities. Please go ahead. Udit, your line is unmuted. You may please go ahead with your question.
Yeah. Am I audible?
Yes, you are.
Yeah.
Yes.
Thank you for taking up my question, sir. Just one small clarification. How much price increase are we taking in domestic and export markets in the following quarters?
Yeah, for the laminate around 7.5%, and for the export will be in the range of around 3%.
And sir, will it be possible to give us the margin distinction for the quarter in exports and the domestic business?
No, it is margin is very difficult to calculate for an individual business, because the same product is same raw material, same product is being from the same plant. So it is difficult to give the margin individually for domestic and export.
Okay, sir. That is from my end.
Thank you.
Thank you. The next question is from the line of Nikhil Agarwal from BD Capital. Please go ahead.
Yeah, good afternoon, sir. So I wanted to understand. Hello?
Yeah, please go ahead.
Yeah. So I wanted to understand, where do you import your raw materials from?
So, Nikhil, various raw material comes from the various sources. So, let's say if I tell you that the design paper comes primarily from the Europe and from the Europe. Chemicals, it can come from any source depending upon, because it's a commodity. It can come from US, Europe, Middle East. It can come from any source. Food again mostly comes from the Europe and some part of the China also. So various commodities will be coming from several countries, but it's across the globe from where our raw materials are.
Oh, okay, sir. And so I wanted to understand, like, the board has issued approved issuance of non-convertible debentures worth up to 150 crores. So is that for the expansion that's taking place?
So it will be used mostly. We want to shore up our cash on balance sheet, and it will be used mostly into the upcoming our future plans.
Okay. Okay. And so can you give me like the breakup of your export markets, like the proportion to which you export, like Middle East, Europe?
Difficult to give the country-wise detail, but we export to almost across the globe. We have presence from, let's say, South America to Australia. We have presence in almost all the markets. So it's difficult to offhand. I don't have as of now country-wise details with me, but we have presence all across the globe.
Okay. No, okay. So just one last question. I wanted to understand your distribution channel in India. Like, do you do mostly, is it retail or is it private builders, or is it like, I wanted to understand the distribution channel.
So we follow the distribution-led model in terms of we will have distributors, and this I'm talking about laminate and primarily laminate. We will have distribution across the country, and from those distribution, this material will go to retailers and even to the builders and all this. Some of the category of material which will be going directly to builder, let's say doors and floors. And apart from this, we will have direct billing to some of the bigger OEMs. Otherwise, mostly we will follow the distribution-led model, wherein the company to distributor and from distributor to retailers and dealers.
Okay. And so the OEMs, the margins in the OEMs will certainly be lesser than the direct distribution channel, right?
Yes.
Okay. Thank you. That's it from us.
Thank you. The next question is from the line of Bhavin Chheda from Enam Holding. Please go ahead.
Yeah. Hi, Saurabh.
Hi, Bhavin.
Yeah. After this price increase of 7% and 2% what you mentioned in export and domestic, will the gross margin be back to 48-49% which we used to be, or you need more price hike?
So, Bhavin, that was a plan, but after we announced the increase, further costs have gone up. So I don't think we'll be back to that 48-49%, but I do think we'll improve versus what we did in Q2. Okay. And also, in order to improve the margins besides the pricing, like we said, we're also trying to drive more value-added item sales, more texture sales. So that's also a very conscious effort we have taken. So let's see what the outcome will come, because the RM cost situation is so surprising. You know, it's quite bad actually.
Sure. And again, the paper prices are rising after a long time, so it doesn't look to be coming down in a hurry. So, because chemical prices are too volatile, but I think the paper prices are increasing gradually. So, what's your view on the same?
So we had factored in some, and we have passed on some increase, as you know. So the focus really, what we can do is maximize volume, which we are doing, maximize the value mix within that volume, because there still is a adequate opportunity we have to improve the value mix within the production output we are doing, and we are increasing and we have prices. I think all of this combined should clearly improve revenues and also improve percentage of gross margin, and in value terms, obviously, gross margin should do far better.
And I was seeing your decorative veneers and light products blended NSR, which saw actually a dip on a quarter and YOY basis. So, any significant mix change there since you had a very sharp volume growth there?
So, business revenues have gone up in the wood and allied segment. There too, we've had cost pressures as gross margin has come down versus last year. Not versus Q1 though. So clearly, I think volumes have gone up, costs have increased. in that business also, in veneers, we've done a 10% increase to be implemented in this quarter. We've done an increase in the flooring business. The exports committed orders, we've by and large completed that. That faced a challenge with sea freights going up. So I think the model there also is a little bit, going through a little bit of stress with 100% imports, with RM costs, sea freights going up, and time lag between costs going up and prices being passed.
Sort of my question was, blended realizations have gone down. So was it a reason?
Yeah, it's gone down. That's a product mix, by and large.
Because of the product mix, yeah.
Yeah, product mix.
Okay. Otherwise, you have taken hike in this division also.
So this division, we had taken a hike, but costs have gone up beyond that. So we've announced one more hike in flooring and in the veneer business also.
Sure.
And in flooring, by and large, we've increased prices for the exports market also, which either will get accepted by the customers or we won't get the export business of flooring.
Sure. Thank you, Saurabh and Tessa.
Thank you. The next question is from the line of Rupesh Jain from Intelsense Capital. Please go ahead.
Hi. Hello, sir. Thank you for the opportunity. I just have one question. In one of the older calls, you said that India is getting far more competitive in laminates or some other markets. It's getting difficult or uncompetitive for them to set up a new capacity. So can you please give more color in terms of this competitiveness? And then another question to that is in tiles we see that Morbi is kind of going crazy in exports. So something like that can happen in laminates, and will organized players benefit from if there is a shift happening? Thank you.
Yeah. So in terms of your last question related to tiles, several manufacturers of tiles is there in the market and whether the same can happen in laminate. So we believe there are sizable number of such producers, laminate producers are already there in the Gujarat. But most of them are focused on the domestic segment, because unlike tiles, there are in the laminate business, so there are big differences than the tiles, and then design specifications as well as various their quality parameters need to be maintained. What we believe the organized segment player has a clear advantage in the export market in comparison to unorganized segment, and I think they will continue to gain the more market share in the room. That is the reason that you will not find much players in the export segment unorganized. Mostly organized players are doing the exports.
Okay, and in terms of competitiveness, sir, if you can throw some more color.
So, competitiveness in the current scenario where the raw material prices are on the continuous run, and in most of the cases there are cash flow issues also, because most of these suppliers, because of availability is tight and all this, so they have also started demanding, and we have also faced this in some of the cases. They have started demanding immediate cash, or they've reduced the credit terms which was there previously. So which is putting more pressure both on the demand side as well as on the cash flow side on the domestic on the unorganized segment. The bigger players, because of their sheer number of size and balance sheet, they are able to continue in this scenario, whereas the smaller players are facing more crunch both in domestic, both in the demand as well as in the cash flow side.
So I was asking more from international competition point of view.
So I'm sorry, I also lost the plot. So on international competitiveness, are you asking about us competing with international producers, or is it international producers or international? I think in one of the calls we said, which is correct, that internationally setting up new plants or expanding newer capacities is far more expensive than doing that in India. and that brings more competitive advantages to the domestic Indian producers. Is that what you're talking about?
Yes.
Yeah, so that is correct. Yes, I think, and that is happening, and we think.
I mean, what has changed, sir? Why, my question is, why has
in 3 months nothing much has changed, boss. In 3 months, not much has changed. I think it's just the same. So, yeah.
Okay.
Within the quarter, nothing much changed. I'm saying it's moving in that direction, and costing.
Do you see secular export growth for Indian organized industry over the next 3 to 5 years?
So when you say secular, I'm not sure what you mean. Like,
15%.
So
Let's say
clearly,
15%.
well, if you ask me, I think that's doable if the businesses and companies have the right capacities and right, market openings, and the right positioning, the right products for these markets, the right programs. I think it's clearly doable because globally capacities actually are not getting added on, and we are getting more competitive in terms of getting more scale, which means we have more opportunities to serve customers across different sizes, different colors, different texture plates. The production cycle is quicker, the churn is quicker. So I think there is an opportunity. Whether it becomes, is it 15% year on year, it's 10-12%, volume is something one is to see, but I think from a possibility, it looks good.
Okay. Thank you so much, sir.
Thank you. The next question is from the line of Akhil Parekh from Elara Capital. Please go ahead.
Thanks for the opportunity, sir. My question is actually in line with what you just mentioned.
Mr. Parekh, may I please request you to speak a bit louder? Your audio is not clearly audible.
Is it better now?
Yeah, it's better. Go ahead.
Yeah. So in past, we had, kind of alluded that the sustainable growth in laminate business is around 10 to 12%. But in obviously first half of FY22, we have seen significant growth, obviously on a lower base. Do we see any structural shift in terms of our growth targets on an annual basis in coming few years, or the shift which we are seeing right now, from unorganized to organized is kind of just intermittent, and it might come back a year or year and a half years down the line once the freight costs, RM prices kind of stabilize?
So I don't know the answer to this, honestly. What I do know is that in the laminates business, once you gain more market share, right, and once unorganized companies' supply chain gets broken, shade cards, catalogs, samples, displays from the dealers, distributor shops get removed, and some other brands or companies, displays, catalogs, come up in those spaces. The ability to bring back the market share for anybody, whether it's unorganized or a company, is extremely difficult, right? So once you gain that market share, whether it will permanently be that way, or it'll again come back to the old ways, I actually don't have an answer to it. I hope, that it is permanently that way, but we'll have to just see how this goes.
Second on the capex side, right? I mean, next year, third quarter of 23, we are having big capacity. From an industry perspective, are we seeing any major capacity additions in the laminate business, which can possibly lead to a supply glut and a price destruction?
Actually not, So laminate industry is anyway, the supply is more than demand, and so clearly I think capacity being available is one thing, and running the capacity is another thing, because to run the capacities, you need the right program, the right markets, So I don't think we're looking at that.
Got it. Just from a financial perspective, if you can give the number of capex guidance for this year and next year, and second on the working capital side, like we have reached at around 80 days for first half of the year. Is this number sustainable?
So I'll have Ashok respond to that.
Yes. For this year, we are expecting around 35-40 crore of capex, which includes some of the normal capex and some of the capex which were announced last year but will get completed in this year. For the next year, the routine capex for the existing plant will be in the range of around 20-25 crore. And apart from that, we have already announced capex for a new plant in south. So we have announced that around 1.5 years before, and we are in the process of seeing, since due to this delay, whether we need to increase our capacity or not. But as of now, we have announced that around 175 crore of capex for the new plant.
Okay, got it.
And also 175 has already been done actually. Yeah. And to answer your other question was, is the working capital sustainable? Yes, it is sustainable.
Got it. Thanks a lot and best wishes.
Yeah.
Thank you. The next question is from the line of Shrenik from JM Financial. Please go ahead.
Hi, thanks for the opportunity. Firstly, I would like to understand an accounting.
Sir, may I please request you to speak a bit louder, sir?
Is it audible now?
Yes, you may.
No, it's not clear, boss.
Am I audible now?
It's better. Yes, go ahead.
Yeah. So could you please explain why the employee cost and other expenses are on the higher side in this quarter?
No, so why are they higher, or are they on the higher side?
They are on the higher side on quarter-on-quarter basis. So could you explain on that?
So yes, so on the employee cost, there was a appraisal cost which was done in Q2. So some of that also has the impact of Q1 in Q2 because it was announced in the quarter of this financial year. On other expenses, there have been some launch costs of product categories, etc., which should to some extent get normalized going ahead.
And the traveling, since now the economy is opening up, and now so the physical traveling is also it started. So that cost is also going up, which was subdued in the entire last year and the quarter one of this.
But as a percent, all these costs are within control or lower than previous years.
Sure, sir. And so for the new south plant, will there be no capex in this current year? It will be fully for FY23.
Oh, so land already, so on that capex, approximately until now, close to 50 crores already has been spent, right?
On the land,
yeah. So maybe in Q4, there will be capex as advances, as we see things now for contractors get mobilized, equipment advances, etc.
So how much can that be expected to be?
In the range of around 30 to 40.
So total capex of 40 plus 30. So total 70 crore capex can be booked in this year, right?
For the existing, I said around 35-40 crore. And for the new unit, it will be in the range of around 30 to 40.
Sure. Thank you.
Thank you. We take the last question from the line of Nikhil Agarwal from BD Capital. Please go ahead.
Yeah. So I wanted to understand, is there any growth guidance and margin guidance going forward for this year? And FY22.
I'll ask Ashok to talk about that.
Nikhil, in this scenario, it's difficult to give the guidance, but what we can see that the quarter two numbers are very achievable numbers, and if everything goes the way it is going, so then probably we will be able to achieve numbers near to this.
In terms of top line.
Okay. Thank you.
Thank you. There are no further questions. I would now like to hand the conference over to the management for closing comments.
Thank you, everyone. Thank you for your time. Thank you for your interest and your questions. And Ashok and some of us are available if there are any questions post a call. You can reach out to them. Thanks a lot.
Thank you.
Thank you. Thank you, everyone. Thank you.
On behalf of Greenlam Industries Limited, we conclude today's conference. Thank you all for joining. You may now disconnect your lines.